So where were the main areas of riches in 2014 in the Sub-Saharan markets? Who were the winners?
Michael, it's been a tale of two halves, and I think starting with the positive side is a good place to start. So certainly on the east coast of Africa have really benefited from the declining oil price and the expectations as well of future growth. So if you look at the Kenyan market over 2014, it rose 20%, and a lot of high-quality companies have certainly produced spectacular returns on the equity market, and it's been backed up by earnings, which is very good. That's Kenya, and then Tanzania too. They lifted foreign exchange controls on the equity market, and that's seen a rally of 35%. Also backed up by a strong economy and a lot of positive developments on the infrastructure side.
Just drilling down into, I know those two places are very different, but are we talking about infrastructure companies, for example? I mean, who are the main winners within the sectors?
Yes, Michael, it was infrastructure companies and Tanzania Cement, or Simba Cement, one of their products, has done exceptionally well. And I think demand for those cement companies has grown. And it's not only Tanzanian listed companies, companies such as ARM Cement, which has brought a lot of production on stream in Tanzania, is certainly looking to benefit from that market. And
so moving westwards across that swathe, where do we go next?
I think if we'll go past southern Africa for now and focus on the west coast. I think it has been a challenging year on a number of fronts. And if you look at Nigeria, has had its own set of I'd say exogenous and endogenous factors, and most certainly the oil price has had a big effect, falling below $50 a barrel. And I think it's important to understand how that affects the country. Now, if you look at the government budget, it's about 70% of revenues, but the foreign exchange reserves that are generated by oil is 95%. So that's caused a lot of pressure on the currency, and we've seen a devaluation, the central bank having to move out its band, and there's still further pressure on the currency. And I think pressure on the currency puts pressure on the economy. People's disposable incomes are lower. There's concerns over how the government is going to finance its infrastructure, even public spending going forward. So
and with an election, you know there's going to be public spending promised, don't you? Let's talk about 2015 then, Jonathan, after that sort of tour of 2014. Where are the bright spots going to be?
I think, Michael, it's still going to be a tale of two halves. But I think as an investor, you have to look carefully at how much are you paying for what. And I think if we drill down into individual companies within the countries, we've seen Kenya had a tremendous run over 2014. And yes, the economic growth story is very good. There's a lot of positive catalysts coming through in the economy, but the valuations are fairly rich. And I think
so just to put that into they're too high. Now you're paying too much.
You're paying too much. If you look at a simple ratio such as PE ratio, you're looking around about a 17 for Kenya. But that's where, as an investor, you have to look carefully. Where are there pockets of value? And we've seen a lot of push in the large caps. Some of the Kenyan banks have performed particularly well, Safaricom, a telecoms company, and we see those as fully priced. But if you look deeper down into some smaller companies, there's suppliers, say, to the brewing sector that are undervalued, and we're seeing value there, potentially in the insurance sector as well, which is overlooked compared to the banking sector, but has had a lot of positive regulatory developments and also more interest from the investor community.
Jonathan, it's great to talk to you, and I think this is a theme which we can continue well into 2015. And as you say, it's always interesting to drill down and have a look at maybe the suppliers to the headline companies and see what they're doing. Jonathan, for the moment, thanks so much.